On today's show, of course, we're talking economy, we're talking tariffs in perspective, and we're going to talk about venture capital for dentists. Let's go.
Consult an advisor or conduct your own due diligence when making financial decisions. General principles discussed during this program do not constitute personal advice. This program is furnished by Dentist Advisors, a registered investment advisor.
Welcome to Dentist Money's 2 cents, where we help dentists navigate all the noise. I'm Matt.
I'm Rabih.
Yeah, you are, Rabih. And I'm on vacation, sort of.
Lucky you.
Am I on vacation?
You are on vacation.
I am.
Yes.
It's vacation masked as a work trip. We have to do this. We do this every year. The last 4 years, we have gone out with the Elevation Association. Shout out Dr. Jared Hill, Dr. Dan Nelson, and Ryan Passy. We love this group. We've been partnered with them for, and when I say partnered, really just meaning like we collaborate with them. They're an amazing group out of Idaho. They do this Life Summit every year, and they pick a new place all over the world. Tend to stay kind of in a similar area. The last 3 years prior to this, we were in Central America. And then this year we did we're in Dominica in the Caribbean, which I will admit, Rabih, I did not know Dominica was a place until I'm not going to lie. I will be totally honest. I'm admitting I'm not afraid to, I have no shame on this show. When we were talking and they were like, oh, we're going to Dominica, I was talking to Jared and I was like, oh, cool, Dominican Republic. And he's like, no, it's Dominica. It's a different place. But I don't feel that bad because we're here with a group of like 40 and pretty much the entire group. I don't know what this says about our group. I don't know. Most everyone was like, yeah, I was the same way. Like I didn't know what it was or where it was. So
doesn't matter. As long as you're having fun, it doesn't matter.
We're having fun. It's great. So we're here for the Life Summit. So basically, if I have to give them a shout out because if you're a dentist listening and you're looking for different types of CE, they've reinvented it. It's really amazing. And we're trying to kind of do similar to what they have done. A lot of our inspiration for our summit has been from Elevation Association, just trying to find kind of a different approach to CE for dentists and make it feel truly more like a vacation. You know, you're here with your spouse or your partner. We do different meetings throughout the day, but then spend most of the time just getting to know everyone, hanging out, doing activities. We've been snorkeling. It's been awesome. So I am technically working, but not really. I've had a couple of times. I've spoken twice here. Ryan and I have spoken. But other than that, we've just kind of been hanging out and having a good time. So, but couldn't miss 2 cents. I was actually down having lunch, Rabih, and I get the text from you like, hey man, are we doing 2 cents? And I'm like, yes, we are. Let's jump on. So here we are.
No, you guys are having a fun time. We're all jealous of where you are, but yeah.
It's amazing. I was telling you as we were getting on, I'm sitting here looking out over the bay, over the ocean. We're up on this mountainside. And I'm very, very lucky, very fortunate to be here. With that said, let's talk American economy as I sit here looking out over the ocean.
Well, I got some new economic data to talk about. So that's my own vacation.
Yes. You're like, we're kind of both on vacation. I'm sitting in my new car smell.
You're not that special, Matt. I've got numbers to play on.
You're like, what's better, Dominica or is it talking economy? I don't know. I get to do both.
It is, all right. For me, it's talking economy. There hasn't been much happening, but it is very interesting. We got the, Q4 GDP and it came at 1.4 on an annualized term. And we were like, oh, but the expectations were 3. It only came at 1.4. It merits that we zoom in, we understand what is bringing this 1.4, what is driving the economy in Q4. Then we'll look at it across the whole year. And I found this very interesting. Actually, I'm not going to say anything. I'm going to tell you the numbers, and then you're going to tell me what is keeping this economy afloat. Okay?
Okay. Okay. All right. I'm nervous.
I have that picture shared with you, so you're not going to be thrown off by numbers. But the GDP grew at a 1.42 annualized basis in Q4. And there are 4 components to the GDP, as we know. There's the consumer consumption, there's business investments, there's government spending, and then there's the net import-export international trade aspect. These 4 components contribute to the GDP. So what brings this 1.42? How did we get to it? Well, you have to sum these 4 together. Let me just tell you, consumption gave us 1.58%. Investments was 0.66, government was negative 0.9, and net exports import was kind of flat around 0.08. So the whole economy is consumption.
Spending.
It's consumption. It's what we are consuming on. And it's very interesting because we can break down consumption into two parts, goods and services, right? With goods, it's flat, negative 0.1%. Whether they are discretionary goods or non-discretionary goods, barely any change. Like, yes, the whole economy is supported by consumption, but it's not good consumption. It's services consumption. Services consumption contributed to 1.56%, right?
And why do you, I'm curious why you characterize that as not good consumption?
No. Goods as in like physical products.
Goods. Sorry.
Yeah.
That makes more sense. I was like, you're saying it's not good. Interesting. You're just saying the consumption we're having is from services
and
not
from
goods of any kind.
Yeah, whether they are durable goods like, I don't know, your washing machine, your car, etc., or discretionary spending on goods, whether it is the food you're buying, I don't know, a TV, like smaller purchases that don't last a long time, but they are physical goods, right? Like, how often are you buying new headphones, type of stuff.
Yeah.
So
yeah.
all of our consumption as a country is based off on services. So let's go a little bit deeper into that. Usually services are more expensive than goods. And whenever you're purchasing a service, especially in this country, what do you end up doing? You pay tips and you pay delivery fees. And
don't even get me started on tips.
Right?
Yeah.
So what is happening is that the economy, the data just came in to re-emphasize the fact that we are still living in a K-shaped economy. Higher income earners in this country spend more on services than they spend on goods, and lower income families spend more on goods than they do on services.
Which is why you're seeing the split.
And this is crazy because we said the whole economy is supported by spending, and when we zoomed in on this spending, all the spending was coming from services, which tells you only the affluent portion of the consumer class is supporting the economy right now. This is something that raises eyebrows, whether everyone is able to contribute to the economy just to stimulate it. You've got the lower 50% or the lower, probably 80% of this economy not spending enough to stimulate the economy. It's dependent on those 20%, which is not necessarily bad. The economy still grew, right? But it is a more vulnerable state than having everyone in the economy spend and stimulate the economy.
Well, and I think it gives a little bit of light to what we've talked about many, many times on 2 Cents, which is there's this, what feels like a split around the narrative or what's being felt by people versus what the numbers are showing. And to me, this makes a ton of sense. It's like, well, the typical American is feeling angst and anxiety and pressure and pain, where the numbers, just if you looked at the top line number, you're like, wait, but the economy's growing, like we're doing great. That makes sense. That totally makes sense that there's a split socioeconomically of who's doing well and who's not, which that's not a good thing, Rabih. That's got to lead, and with just decisive or divisiveness that we have already politically, this has got to add to that.
100%. And when we say now the economy has become more vulnerable, you can kind of understand where that vulnerability comes from. So lower income consumers of this country are really more affected by inflation or prices rising, or by a recession getting laid off, than by a stock market crash, right? Because if the stock market crash, well, they only have a little bit in their 401ks, maybe an IRA right now.
They don't feel that.
They won't feel a crash. Whereas the top 20% of consumers in this country, well, if you look at their balance sheets, it's mainly their big houses, their big brokerage accounts, retirement plans, their feeling of being rich, and this is where dentists belong, by the way.
I was going to say a lot of dentists, yeah.
Is really dependent on where financial assets like stocks, bonds, and real estates are sitting right now. We're saying that the economy right now is completely dependent on spending, and it's completely dependent on services spending, which comes from the top 20% of consumers. The needle that will break the haystack for those people is a correction in asset prices, because suddenly they won't feel as rich, right? they will cut down on their spending, and now there's nothing contributing to spending into the economy, and would go into a recession. This is the
Interesting. So
vulnerability.
yeah, that makes sense. There's a direct ripple effect of when that correction comes, and I say when because it's happening at some point, we just don't know when, that will have a direct link. The dots will dot to, well, now that number, which is basically we're highlighting as propping up the economy, the consumer spending at the top at half of the top quartile of the population is going to feel less rich. They're going to stop spending. That's going to be the thing that all of a sudden it's like, well, no, now our GDP has gone negative.
Yes. And
Got
this
it.
is why, I don't know, you've noticed me for the last like 2-3 weeks, I'm really curious about what is the stock market doing? How much could it fall? How much could it rise? Not because we care about timing the market or trying to understand or predict where the stock price is going to do. We still have a concrete belief that we can't really do any of that thing. But because at this current status quo in the economy, knowing what contributes to the economy, we are more dependent on the path that the stock market takes. We do not care where the stock price is going to be because our investment strategy in the long run, we're going to do better.
Sure.
But for the next 3 months, for the next 6 months, we could have multiple paths in the stock market. And it happens that right now, due to this systematic factor of who is spending in the economy, that path that the stock market might take will influence the path that the economy might take. It doesn't always happen. But right now, we're in a situation where a path in the stock market influences the path of the economy.
I'm so glad we went down this road, Rabih, because I think this is often a question people ponder is what's the difference between the stock market and the economy? There is a difference. But this is a perfect example of how they can feel directly linked. I'm so glad you brought that up.
If
really
everyone
good.
is
You broke
feeling
it down
rich,
perfectly.
If everyone's feeling rich, the top 20% are spending, but also the bottom 80%. If a stock market crashes, no one would care. The top 20% won't spend, but the bottom 80% will keep the economy afloat. But right now, we're seeing that the lower 80% aren't contributing. It's only the top 20, which puts the economy at a vulnerable. Doesn't
That's
say that the
interesting.
economy is bad. It's just vulnerable.
Yeah, really good perspective. So we got to just hold on, hope the stock market can hang on for a while, keep this going.
Yes, or start thinking of policy that would allow the bottom 80 to participate again into the economy. Get them out of that slump.
That's the real answer.
Yes.
That's the real answer.
You want everyone spending, not just the top 20%.
Exactly.
So this is where it comes to the consumers. The other one, but it's really even less the amount, is investments from businesses, right? And investment from businesses happens in two portions. It's either fixed investments, like new investments that they're making, or the changes in inventory. And inventory changes are like, do we expect the economy to start slowing down? So we start emptying our inventory because we don't want to sit on a stockpile of products we don't sell? Or do we expect the economy to start booming so to be ahead of the curve and to make sure we can win market share and win clients, we're going to start expanding our inventory ahead of time. So the inventory grew at 0.21%, which is low, but it's not negative, right? And fixed investments were the 0.45. So 2/3 of investments came from actual new investments and 1/3 was coming from expanding inventory. But just like in consumers, where you zoom in a little bit more and you look at it services versus good, with investments, you can look at them as residential investments versus non-residential investments. And why are they those two categories? Because this country really cares about its housing market. It's a big portion of the of how the economy grow. More investments in houses grow the economy, right? New houses being built grows the economy. So if you look at residential investments, they are at 0% or negative 0.06. So all of the business spending that's happening is not happening in the residential aspect of the economy, which tells you the housing problem is not getting its fix from businesses trying to supply more houses.
Well, and really quick, Rabih, I think there's a link here too. When you talk about we care about our housing market, could you make an argument that as we talk about policy being the real answer of getting the bottom 80%, spending again and feeling good again, I think you can make an argument that this is a housing, like singular issue, which is housing in the fact that housing is so expensive. We know this. This is like the one factor that is consistently shown that like this is not normal right now of how expensive housing is compared to like real wage growth and employment and all this stuff. Could you make the argument that this is just simply a housing issue? Because when, let's say that 80% can afford a home, right or wrong, they feel less wealthy. They make different decisions when they're not in a home yet. They're maybe saving for a home, so they're not going to spend on goods. They're making different money decisions, which has this ripple effect we're talking about. So this is above my pay grade. We're just hypothetically talking about this, but I think you could make an argument of like the policy to solve this is a housing policy to get whatever that means, to get people in homes or being able to afford homes so then they can start spending money and propping up the economy from that end, not just the higher end. Does that track?
It's a good hypothesis, and with this if this hypothesis is true, you're hitting two birds with one stone, because you are doing policy regarding housing, and we don't know right now, it's all over the news, affordability, etc., right? Putting the politics aside, there is a claim that could be made. It's like the bottom 80% are not spending because the housing market isn't helping them, right?
Yeah.
And the fixed income, the business investment into residential real estate is also not picking up because the current market doesn't help them. We need policy that would stimulate it, probably lower interest rates, etc. Right? It could be the case, but unless we collect very certain data and look at it statistically and try to measure its impact versus other stuff that might have a bigger impact, we can't say for sure. But is it a hypothesis that you could test? 100%.
Yeah. Yeah. One thing we do know, though, to your point, one thing we do know for certain is that home prices being unaffordable is pretty simply a supply issue.
Yes.
Right? I mean, we know that. We have a shortage of homes. Yeah.
100%. On the other side, so where is business activity contributing? How are businesses actually contributing to the economy? Well, they are contributing by non-residential investments. And what are those? Data centers. Everything is coming to this. AI data centers, one data center after another. This is what has been keeping, I wouldn't say the economy afloat. Spending is what's keeping the economy afloat. But what's keeping the businesses... how do I say this?
The business investment portion of GDP.
100%. This is what's keeping the business investment portion of GDP positive. And if you took away data centers, businesses for the last 6 months haven't been growing the economy. They are there. They're just servicing, but they're not pushing the envelope towards better living standards. They're not making the pie bigger for everyone. So they're not circulating money into the economy. So, like them or don't like them, data centers are what are keeping, spending from in the business sector coming so far. That has its, overflow aspects, like this is putting more pressure on electricity prices.
Yeah, energy,
etc. But here's the thing, all those that we're talking about, they're neither positive or negative objectively in a sense. It's like, these are the numbers. This creates an economic reality. It doesn't objectively have to be good or bad. It really depends on where are you in the economy and whether you're benefiting from it right now or you're not benefiting from it right now. And on average, it's neutral. It's really neutral on average.
Yeah.
Okay. So there's consumption, there's investments, and what remains is the government impact on the economy and net imports export. Government impact on the economy kind of cancels out, but government impact on the economy is usually states and local taxes and federal spending. Federal spending has been getting cut, right? Or I have more numbers on it in a second, but it's not contributing to the economy. It's shrinking, which is something we like. But states continue to spend, so they net zero. And trade is actually not bringing... had a zero impact in Q4 on the economy. Like, we did not import more than we export, which is fine. But I have more on that in the next section where we talk about tariffs. Yes. So, what do you think of the whole economy thing?
I thought you broke that down really well, and which is shocking because you tend to not really break things down very well. It's weird.
Yeah.
You've gotten better though since you've been a professor. I feel like you're nailing it. Those skills are really crossing over to 2 cents, which we all benefit from.
Don't spoil
No,
me too much before I start bringing a whiteboard behind me and start drawing.
I'm looking at your whiteboard.
I'll give you homework, Matt. Don't test me.
I appreciate it. I always learn when I get on the show with you. No, but I think you broke it down really well. I love this really digestible way of understanding. I just like the way like the numbers explain what we've been feeling and talking about on this, like we said, around like, man, this feels off. Like, how do the numbers, and even people I talk to, like, why do the numbers look good? Everything I'm seeing looks good. I'm supposed to believe the economy is going well, but there's a disjointment of that versus what I see and feel in my real life. And again, I just love how you broke that down. The other key point that's worth repeating is just the time and place sometimes where things kind of come together, where there's a direct link to what's happening in the stock market and the ripple effect in the economy. I just thought that was really insightful. And the thing that we all know, which is spending continues to prop the economy up. That just continues to happen. And I don't know what changed. I mean, we've highlighted what could change that, a drop in the stock market, but consistent week after week after week is just like, well, spending keeps going. Yep. No matter what cohort of the population that's happening, whatever that's pulling from, spending continues to happen.
Let's hope it keeps on doing so.
I guess so, yeah.
Talking about spending, Matt, we have another person whom we do not like when they spend. Can you guess who it is? The government.
Oh, I was like, another person. No. We don't like when the government spends.
We don't like when the government
Correct,
spends.
yes.
So I know you especially love this data point, and I collected the monthly budget for the U.S. government. Right?
This is my favorite data point of all the data points. Yeah.
It's that chart that is in yellow and blue for you. But I've got the actual numbers. And I'm just going to highlight how much every single month, it's your budget. Are you going over budget or under budget? We're going to be the financial planners of the government for now. And in January 2025, we overspent by $129 billion. In February 2025, overspent by $300 billion. And by the way, the sum of these overspending is what ends up being, we had a $1.7 trillion deficit for the year, right? It's just every single deficit every single month. And if you go through these months, we only had 3 months this in 2025 where we actually brought in more money than we spent. And they were April, right? We got tax season. We got almost $60 billion in. We had June, which was the number where it caught our attention. We talked about it earlier in the year. Is it really the impact of tariff? We had a 27 billion up, but also not really that different from zero. If you're fluctuating in the magnitude of 300 billion, 27 billion is, 10% of that. Yeah. And then we got September, we brought in $200 billion in. But all the other months, we were spending more than we were bringing in. And we were spending in the magnitude of 300 billion every single month. What happens is that we thought that 2025 will be different than 2024 or 2023 just because we now have tax tariffs, and hopefully we're going to curb down that deficit. It came in at like 1.6 trillion. Like we had a 1.7 trillion in 2024. 2025 was 1.6
so
trillion.
Netted out the same.
We really did not do much. Tariffs weren't the answer to curbing down the deficit, to fix the spending problem the government has. And
I was going to say, because we don't have an income issue, we have a spending issue.
We have a spending issue, right?
Yep.
And not only that, our spending issue has become worse and worse as of interest costs. Interest is now around 2.7% of GDP. Just every single year, you're paying that much. The average interest rate that the US is paying right now on all its debt is around 3.7%. We would want, if inflation suddenly disappears, which is not what's happening, we just got data this morning that inflation is worse than expected and the stock market corrected for that. But if inflation suddenly disappears, and it's nothing that we worry about, I think interest rates would be so beneficial. It would be so beneficial for the 80% consumers, for them to start spending. It would be so beneficial for businesses, so not all their activity is just concentrated in data centers. And it would be so beneficial for the US government to kind of have a lower interest expense every single year, rather than and have it go to, I don't know, Social Security, Defense, Medicare, whatever you want, but not just repaying the debt, right? Like,
Yeah.
lower interest rates would be helpful, but we are in a position where you can't just lower interest rates right now. You are risking the whole credibility of the US dollar.
Yeah.
So this is where we stand. But I collected more data about the money coming in. I know you said our issue is spending. We can't do anything about it. But let's look at the money that's coming in, the money the government, the revenue the government is bringing in, all the different taxes, along with the tariffs, and just see like how much did our revenue change because of the tariffs. Like, did we used to get 90 or 100% of our money from tax revenue and corporate taxes, etc.? Now probably 60% of it comes from taxes and 40% comes from tariff. Like, how big of a dent did tariffs make in the amount of money the government brings in? These are the data that I collected, and I have them for every single month. By the way, I don't have them shared with you, but I have them for. But if you look for the last 12 months, so from February 2025 until January 2026, which is this administration term, so far, what happened? What happened is that the government brought in $5.4 trillion of revenue from taxes, Social Security insurance payment, Medicare payments, tariffs, employment taxes, you name it. All the money that the government collects on, they summed up to be 5.4. Of course, we spent 6.8 or something,
Yeah,
right?
yeah.
And we went into a deficit
Almost
for the
7.
year,
Yeah.
adding to the debt, but we got in 5.4. If you look at it, 50% of those, 51% of those, so 2.7 trillion comes from individual income taxes, or, the taxes you pay on your W-2s, etc. That is 51% of all the money the government brings in. 32%, 1.7, comes from employment and general retirements. These are the taxes, like the payroll taxes, in a sense. Like, you pay your own W-2, but your employer is paying the payroll. There is 32% coming from payroll, and then you got 33% or 1.7 trillion coming from social insurance and retirement receipts. So that's not the W-2. This is the Medicare Social Security portion that everyone pays.
Yep.
Those were another 33%. So you've got 50%. Go ahead.
That's most of it, right? This is the majority. You just highlighted 51, 32, 33. This is pretty much all of it.
Those pretty much all of it. You're talking big portions. They sum up above 100, by the way, but there are losses and nets and refunds. So
Sure.
the numbers aren't clear data. But if we look at the numbers, we said 2.7 trillion, 1.7 trillion, 1.5 trillion, 1.7 trillion. How much did tariffs bring in? Tariffs brought in for the year 285 billion in magnitude compared to the actual stuff that bring money into the economy. Tariffs only brought in 280 billion. And by the way, I have the numbers. Like, if you look at the money custom duties, like the money paid because of tariffs that the US government received, in February 2025, they got only 7 trillion. In March, it was 8 trillion. And then Liberation Day happened, correct? And that 8 trillion jumped to, not 8 trillion, sorry, my bad. 7 billion, 8 billion. And then Liberation Day happened, and that money that comes in from tariffs jumped, or doubled in a sense, to 15 billion. And then May, June, July, August, all the way, it was like 22 billion, 26 billion, 27. So you could see the jump. We were getting around $7-8 billion a month from tariffs. Now suddenly, after it adjusted, we're getting like 27 or 28 billion. Like, we added $20 billion a month. And that is why they said the impact of the tariffs wasn't the whole 85 billion. It was 175 billion, because we already had some flowing. So is it enough? Like, honestly, when I was looking at the numbers, the first thing that came to my mind is like, okay, all the stuff in politics, all the stuff in the media, all the blah, blah, blah is just for $285 billion received versus the 5.4 that we received. Why are we giving it so much weight and pulling it out of proportion? It's more politics than economics, right?
Yeah. Well, it's funny. I think it's... you're right. This dominated headlines during that time. And this is kind of, I think, one of those things where like both sides were wrong, because on one side, all of the talk was this is going to implode the economy, lead to I heard a lot of rhetoric around, this is going to be worse than the Great Depression, all this stuff, lead to war, well, all this stuff. That clearly was not correct. It ended up being nothing. But on the other side, I was told and heard that this is going to solve all of our problems economically. This is going to completely erase our debt and solve all of our economic problems. Well, that is obviously not correct either. So this is a microcosm of what we see, Rabih. Like
100%.
This is the epitome of noise from both sides. The media just loves to talk. Both sides love to yell at each other from the other side of the fence. And reality ends up being not even close to what either side says.
Yeah. So it's like we wasted a year of not doing proper policy because we spent a whole year fighting about the impact of $285 billion will do on a revenue stream that is as big as 5.4. And it's not enough for us that we spend 6.8. I don't know. We need a financial advisor for the country to sit down. It's like, this is like literally what we do to our clients, right? Like you guys are sitting there and you're making sure you understand where are all the ways the money is flowing so you can tighten the gaps and really look at organize everything and collect the data and sit there and try to summarize it in a way that it actually let the data speak to you rather than what you feel you spent or what you feel you owe, etc. And let the data tell you. And it feels like the government is just like a very disorganized dentist at some point.
It's a great example. You're right. We do this all the time with dentists, and we know pretty quickly with data and organization, is this an income problem or a spending problem? And sometimes with dentists, it is an income problem. Like you just need to make more money, and you're at a stage of career, you're in a season of life that you need to continue to invest in your career and your skills and your business and build this thing. And a lot of times that what looks like a spending problem, meaning as a percentage of your income, it looks like a problem in your cash flow statement, but it's just because you're not making enough money yet. It's the same thing on a P&L. We look at a practice's P&L. We're like, yeah, your fixed costs are way too high as a percentage, but not because you spend too much on your fixed costs. It's because you don't make enough money. You're in year 2 of your practice. That is totally normal. Let's keep growing your income. That problem will be solved on the bottom line of the balance sheet by increasing the top line. So we know that, but we also know when we're talking to a dentist, you have a spending problem. Like we know that. Like, hey, dentist, you're making 7 figures plus in personal income and you still are living paycheck to paycheck or racking up debt. You have a spending problem. This is not an income problem. And this is the category of where the US government is. This is not an income problem. As the government's financial advisor, self-appointed financial advisor, I think I can speak for our entire team of financial advisors. We would say this is not an income issue. This is a spending issue. I think one of the most frustrating parts of this, Rabih, is that I think everyone knows this. Like this is this is an open secret that the government has a spending problem. Everyone knows it. No one's willing to fix it. And when I say, and everyone campaigns on this on both sides of the aisle, but nobody actually is willing to fix it. They're just moving where the money's being allocated to, right? As far as from a spending problem, they're all just reallocating cash flow or they're moving the flow of the river to their side or the other, but the number just continues to increase. And this has been the case since the late 20th century into the 21st century. We've never run a surplus since Clinton. We just never have. And so both sides, every term flips, flops, spend goes up and up. So that's the most frustrating part for me is that, and I think for everyone, is that everyone knows it. It's kind of like the real estate thing. We all know we have a supply problem. No one's willing to fix it. We know we have a spending problem in the government. No one's fixing it. I think that's where people get left kind of arms up in the air, kind of frustrated.
Yeah, you're right. It is frustrating. And unfortunately, it's because the interests are not aligned. There's a very famous quote from a politician. I'm not going to say who it is, but he said, "You never lose an election by spending too much money." And this really describes what's happening here.
Yeah. Did we just get too political? I think
No, I did not name the politician.
You didn't name who it was, yeah.
No. But if you know, good for you.
Yeah, I think I do know. Okay, anything else on that? I think that was a really good breakdown of economy, tariffs. I know we had talked about you were dying to talk Iran. We won't today because, like you said, there's been so many things changing. By the time someone listens to this, even if we talked about it, it would change, and we'll maybe save that for another day. Wanted to wrap this up with I was actually sitting at lunch, as I mentioned earlier. I was sitting at lunch with some dentists at this event when I got your text of like, "Hey, you want to do 2 cents?" But right before that, I had a dentist. We were just chatting, and he started asking about investing, and he was asking about brokerage accounts and all this stuff. And he said, "What do you think about venture capital?" And I was like, "Oh, we had a high level chat about it." And then I was like, "Why do you ask?" He's like, "Oh, well, I put some money. I won't name any names. But he said there was this dentist. He said his name, and he said, he built up a big business over a course of several years, sold all his practices, and then got out of dentistry. And then, of course, what do they do? He got into venture capital, and he flipped around and said, 'Hey, dentists, like I can help you do this too.'" So he started selling these venture capital deals to dentists. And so we just had this lunch conversation. I thought, oh, this isn't interesting. Like, let's bring some numbers to this of like, is venture capital a viable place for dentists to look when it comes to investing, and try to give truly, like, our goal here, as we've said, is to navigate the noise and try to give as much as possible of an objective view and just the trade-offs of any investment decision. So we've said this many times, but it bears repeating, is that whenever we talk about investing, that there's only 3 places to invest your money, only 3. And it's private markets, public markets, and real estate. Every single investment you make is in those 3 categories. Private markets is where venture capital would sit. So I'm going to leave it here for a second, Rabih. I can continue to I wanted to break down some numbers, but I want to get you in here on this intro if you have any initial thoughts on venture capital or any of this.
No, maybe just let's set the stage that the framework from which we think venture capital is just a form of equity that is not listed on the stock exchange, it's private. And the difference between a private market and a public market is that in a private market, there is less regulation. There are less need for transparency, for reporting your earnings on a quarterly basis, which could be a double-edged sword. Could either be something that allows a company to properly invest for the long run so it becomes a very big company and generate a lot of returns, but it also allows for a lot of shady stuff to happen. So this is, I would say, a very big differentiating factor between private equity, such as PE or venture capital, which tend to be smaller, younger companies, or established companies that are listed on the stock exchange and are regulated.
Yeah, I'm really glad you made that distinction, because I think it demystifies it as well around like, and what's the mechanism for this? This is capital infusion into businesses to continue running their operations. There's different mechanisms for that. And to your point, VC, venture capital funds, or companies are usually up and comers. They're usually new. They're, like you said, they're not public yet. Which there's a trade-off there that we want to highlight here. So what this dentist was telling me at lunch is, he said he was curious because he had put his money with this person, this former dentist. And he's like, "Man, I did it a few years ago, and I've already seen, like, he spread the money." And I didn't ask details as far as like, how much did you put with him, anything like that. He just said, "I put money with him, with this company, and he spread it across these different ventures, these different businesses." He's like, this was like 2 or 3 years ago, and he said 3 of them have already gone under. He was kind of like, "Man, it just kind of sucks," And he said, one of them turned out to be a Ponzi scheme already, and 2 others are kind of underinvested, whatever. I told him, I said, "This is sad because like we've seen this, we've heard this so many times." But again, let's give some actual numbers and data to this. So the failure rate. So here's let's hit the good side first, Rabih. Let's start with the good side.
Yeah.
The positives of VC, if it hits well, if you're in that, if you happen to be a part of these deals that ended up being a success, I think it is worth highlighting that your potential actual return in something like that, the potential return is higher than that of public markets. Like, and that is pretty intuitive.
More
I
risk,
think.
more return.
Exactly. Kind of the fundamental, like, you're bearing more risks and you should expect a higher return for that. This expected return. That's just a fundamental aspect of investing and how capital works. So that's the good thing that's the good part of VC that I think, again, needs to be highlighted. Like, you can expect higher returns, or should expect higher returns in VC and those types of things than the public markets. Again, I don't think that's that crazy or novel. Here's so any other positives you would highlight other than like expected returns being potentially higher? That's the main one I could think of why it would be drawn to that.
On a spreadsheet, no. And this is the only other one. The other things that people think they are positives is just like bragging rights and being
status.
Cool.
Yeah. I think that's true. Is people, dentists, everyone, whether we like it or not, we all have egos. And I think this sometimes people can get wrapped up in this of like, it's way cooler to say I'm in this VC fund than to talk about your ETFs.
S&P 500. Yes.
S&P, whatever. Yeah. So here's the things to be aware, or to be very aware of when it comes to VC. The failure rate. There's a range here, but this is very well documented. The failure rate of individual VC investments, and VC funds know this, by the way, this is their strategy. 64 to 75% of deals lose money. Like, that is, again, that's just readily available data. 64 to 75% of deals lose money. If you compare this to public markets, so that's like what we'd consider like business specific risk. I invested in this deal, that deal went under. If you compare this to public markets of a diversified portfolio, the failure rate of losing money over time is essentially zero. Like a well-diversified portfolio, we're saying permanent loss of capital in a diversified portfolio over time, that's a 0% failure rate, right? That's safe to say. Liquidity. This is an issue with liquidity that needs to be very thought, or, you have to be aware of. You don't give money. And this is what he said too, this dentist I was talking to. He said, yeah, I gave them the money. I'm just kind of hoping, like, they're sending me reports, but I can't access this money. They told me at least 5 years, could be longer. Normally you put your money in with these groups, and the way these function is you're not seeing that money. Even in the initial investment, you can't touch for 4 to 10 years. That's how they function. These are going to be, you give us our money, we can't be dealing with giving you back money because we're going and deploying this in illiquid investments to grow these companies. Where compare that to public markets, obviously fully liquid, you can access that. Accessibility generally is going to be different. You have to be an accredited investor, or with, in these types of funds, versus public markets, not the same. Anything else you'd add to that as far as just kind of differences fundamentally?
Probably company size is very important in that situation, right? All the companies that are on the stock market usually have, because they did an IPO, they went through the venture capital stage, etc. They're going to be larger than like $10 billion at least, right?
Yeah.
The Nvidia is $4 trillion in company size. VC are going to be startups. Venture capital is for startups. They probably don't even have revenue yet to start with.
Which is why the failure rate's so high.
It's an idea.
Yep, totally. So highlighting really quick key red flags to think about. Will and I did an episode, I can't remember the name, I should have had this, but a while back, several weeks ago, you can go find it, where we did a really detailed breakdown of like things to be like red flags when it comes to investing. But I'll just hit these really quickly. Key red flags when someone's pitching you a VC fund or anything like this. Lack of transparency. So if they're giving you vague details or evasive details around references from founders or other LPs, size, performance, portfolio details, the more vague and lack of transparency, I'd be a little worried. They should have they should have that down of what that is, what this is. This is a big one. Urgency or exclusivity. So I only got a few spots left. That to me should be number one. I think this is not how real operators work. Anyone telling you only a few spots left and pressuring you and trying to get you into something without offering proper due diligence, that is not a legit firm. They are not legit. They are not a proper VC. You'd be doing it professionally. No discussion of risk is a huge one. So pitches that are, the no-brainer pitches, ignoring the failure rate, not highlighting risks of like, this is what this means, and really spending time on that. And then here's a good one, I think, Rabih, low barrier to entries. So like they come to you and say, oh, you can just do 25 grand. You can just do 50 grand. I think that's
Really? Like there's a company out there that's hoping to be the best next Apple of this world, and it's dependent on my 25 grand.
I know that,
You
and
know?
that I tread on this one lightly because I truly don't want dentists to feel like in fear or like, you're not in this ball. You're not playing that same game. But the reality is you're not playing the same game, and neither am I. Neither are you, right? Like, well, you are because you're managing a lot bigger money, but we're not playing the same game. Like, most of these professional true VCs are not going to dentists or any of us and saying, hey, just give us 50 grand, we're good. Like, that's just not. And if they're at that level of seed funding, of like barriers to entry of like, yeah, 50 grand, that should like at least kick off more questions.
Yeah. Actually,
think.
if you allow me to go technical for 30 seconds, usually
Yes.
they ask for like, hey, give us 50 grand and this will complete the fund and you don't have to put any more money. That is a bigger red flag than saying, hey, can you commit 300,000 and we have a strategy. Once the company hits this milestone, we'll give them the first 50K. When they hit this other milestone, we're going to give them the second 50K, etc. If it's only just a situation where, hey, just give us 50K and you're going to be invested and you're going to be part of this fund, this means that they went out there, they collected all the money that they wanted from the people they want to make them money, and then they were short 50K and they just want a sucker in to finish and fulfill the deal. Whereas if you're a proper investor, and this is something we do in our due diligence when we're looking at deals, and most of the time we don't recommend them, right? What we do is that we're looking at these and saying, okay, is this VC company or fund that I'm investing with just a pass-through entity, or do they sit there, think they have a strategy on how they want to deploy their money, and they are actually interested in making me money?
Yeah. I'm glad you went down that road because they could all call themselves VC. It doesn't mean they're the same thing. Yeah, it's a really good point. And then the last one, just talking about a red flag to consider, is the tax-led hype. The tax-led, like they're leading with saving you taxes. That's
well, if you lose money, you can write it off, right?
If you lose money, you can write it off, but you still lost money. So, yeah, definitely be considering that. I'll just wrap up with this. What I told this dentist was, I think there could be a time and a place for something like that at some point for a dentist. I'm in no way saying never ever. I think where dentists get in trouble, I'll tell you exactly what I told him. Where dentists get in trouble is a sequencing problem, as opposed to like the investment itself. So before I think sequencing matters where if we're going all the way to the beginning, like you haven't focused on your business, increasing cash flow, understanding how to grow your business. You haven't mastered that, which by the way takes a long time. You haven't, and then deployed that capital elsewhere into a lot of different areas. 401k, IRAs, HSAs, brokerage accounts. You're doing backdoor Roths. You built up a portfolio. You got your maybe real estate stuff figured or whatever. VC would be like last in line for us as far as like, okay, you've got these boxes checked. You've sequenced things properly. You've built up a really good portfolio. You've got ample liquidity. We know your cash flow is strong. Okay, we want to start swinging for the fences and having some fun with some VC stuff. Sure, let's go and let's research some deals and let's figure it out. But where dentists get in trouble is the 40-year-old who's still building his businesses, hasn't figured out any of that stuff. And he's like, I'm going to go swing for the fences. And this dentist admitted, he said to me, my number one, like I did this to accelerate my path, like thinking it was going to get me there faster, which the ironic thing is more times than not, it actually slows you down, which is the problem. It actually leads to the exact opposite of what you wanted. So any other thoughts on this, Rabih?
No, I will leave it there. I really love what you said.
Oh my gosh. Nothing makes me happier than on vacation when Rabih's like, that was it. That was it. Love it. Any other words in general, Rabih, of anything we've covered so far? Any other final words of wisdom for the people?
It is, honestly, what you said was amazing. And I want them to have the last thing in their mind is that sometimes you're trying to accelerate your path for wealth, and the way what ends up happening is that you slow yourself down. This just tells you that the investment itself is objectively neutral. It's not like, oh, VC is bad or VC is good. It really depends on you. And are you in a situation where VC could be good for you, or are you in a situation where it could be bad? And if you do not know, just hopefully a little bit of this podcast helps you now. If you need more help, just give us a call and we'll help you know whether they're good for you.
Oh my gosh, Rabih, that was perfect. If you are out there thinking, I need help, like you said, we're here, dentistadvisors.com. We talk to dentists all over the country every single year. We would love to talk to you and help you understand, does VC fit for you? Does it not? Or any other question that you have financially, whether it be around taxes, investing, debt, insurance, we're here. This is what we do every single day. We would love to help you as well. I'm actually gonna end with this. Shout out to Elevation Association. We love these guys. If you have not checked them out, you definitely should. Elevationassociation.com, I believe. They don't even know I'm doing this, but I love and respect these guys so much. I want to give a shout out to them. And then Dentist Money Summit, we'd love to have you there in June. Check it out, dentistmoneysummit.com. For now, Rabih, as always, thanks for being here, sharing your words of wisdom. I was here too. Thanks everyone for listening. That was our 2 cents. Till next time, bye-bye.